All right. So today is February 26, 2021. We're going to talk about buying the dip or buying dips in general. You could put that as a plural, buying the dips, because market's in a little bit of a dip. And so that brings up this is a very, current top of mind issue, but it's an issue we come across all the time. And so this could be a little bit of a talk, but then also what I've received over the years, the best feedback as far as presenting information is through exploration together. And so it's kind of showing and playing with the data and finding real information. In the past, I've also done it where I just pull up all the information, I make all the charts, and I make beautiful presentations. But there's something about seeing it happen and asking the data a question and getting the answer out of it, and asking another question and getting the answer out of it. That conversation with the data really just gives a different picture of how things work. All right. And a little subtitle is the paradox of trading truisms, and that's what we're going to start with. All right. So trading truisms. Truisms, if I understand the term correctly, are things that many people believe are true, but to the point that they kind of dismiss them. All right, it's like general knowledge, general wisdom that just seems trite and unvaluable, not invaluable, but not valuable, because it's just kind of too obvious and too simple and not valuable enough. Okay, so the paradox of the truisms is there's too many of them. There's too many of these wise sayings in trading that leave you confused because they're contradictory. They're in a paradox, right? So here are some things that traders say. So traders say the market pulled back. It's a good time to buy, right? Dips have a higher probability, 60, 65%. We can go ask the data the question. I can show you. For now, you just have to trust me. On pullbacks, there is a higher percent chance of buying and being profitable thereafter. Okay? It's a truism. It's trite. It's not very valuable because there's some truth to it, but it still leaves you without the how to do it. All right. So we're going to talk about how to do it today. Second one is another truism. The market is rolling over. All right. This is what is happening. This is the language that's used, but you notice it's saying the same thing, but the words we use are what the difference is. So the market is rolling over. This is not a good time to buy. But aren't they the same thing? Right? It's the same thing. If the market is presently, let's state an absolute fact. The price of the market is lower now than it was a week ago. Okay? There's an absolute fact. But one trader says the market pulled back. There's a higher probability entry. Another trader says the market's rolling over. It's not a good time to buy. It's weak. Which one's right? Well, they're both right about their observation, but their words and their logic and their truisms that they are using are leading them to something else, a different outcome, a different interpretation. All right. Another truism. The stock is already up a lot. Man, I hear this one a lot. This one's up a lot. Okay. This stock's up a lot. It's not a good time to buy. Okay. It's so hard to argue with that, right? It's just they say this statement, and I'll even have a position on the stock. I'm holding the stock. My automated systems are running the stock. I'm long. They're like, oh, it's too expensive. There's no fundamentals. And there's like all these no fundamentals. Wow. What a powerful statement. How can I argue with that? There's no fundamentals. It's too high. Yeah. Like, okay. Like, how do I argue with that? I don't know, but I own it. Whatever. I could even lose a little bit of money on it. But one of us, in our logic statements and our approach to the market and what we say about it, will end up profitable and the other one may not. Okay. So the stock is already up. What's another one? The stock has relative strength. It's a good buy. So what do we have here? Now we have two more. Now we have another paradox. We have two more contradictory statements. Both are identifying that a stock, let's say an absolute, example case and say the price is 20% higher than it was a month ago. The stock is already up. It's not a good time to buy. Okay, good for you. This stock has gone up 20% when the market went up 5%. That's relative strength. That's momentum. That's fantastic. Let's do it. Let's buy this thing. Okay, let's do it. Who's right? They both have these wonderful, beautiful traderish statements. All right, like they sound like real traders. They're using cool terms. Their friends are like, man, relative strength. I don't even know what that means. What does that mean? Oh, it's already up a lot. Well, I didn't realize that. Okay, yeah. I don't want to do that. I don't want to buy high and sell low. That's dumb. Yeah. You sound smart. You come with the logic. So what's really going on though? Here's what the traders mean, or what's really happening. Okay, maybe it's not even what they really mean, but it's like what's really happening that makes the trader pick between these two phrases. All right. For those who don't want to buy, or I'm sorry, that want to buy, in either case, market pulled back, great time to buy. Stock is strong, time to buy. They're saying, I'm afraid of missing out, and here's my logical reason to buy. What's happening is they already know what they want to do, or they have a fear or some fear or desire that they want to satisfy. There's some level of dissatisfaction and they want to satisfy it. They want to fill the void of a position or remove the existence of fear. And they will use a really cool term that they've heard before to give them the reason to make a decision one way or the other. Okay. So another one is, I'm afraid of losing. So this is the opposite. I'm afraid of losing. And this is my logical reason to either sell what I currently have or not to buy what I don't own. All right. The problem is, in either case, if it's not based on an edge, then none of these statements mean anything. All right. I was talking to a trader today about the whole, market rolling over, good time to start a strategy or not. And my opinion is it's always a good time to start a strategy. But if you want the actual statistical edge decision involved in, do I start now or start later? Okay, here it is. We have done studies that show if you start a strategy or add a little size after a losing trade or after a pullback, you have a slight advantage over starting when it just has done very, very well. But the advantage is very slight. And guess what? You're actually, in many cases, you'll make less money, but you'll have higher win rate or smoother results, but you actually make less money. So you're actually giving up on potential gains in theory, but you're reducing volatility. So it's probably like a less volatile time to get in. Isn't that very different than just a matter of fact? It's pulled back, great time, or it's rolling over, not a great time. It's like one is an absolute truth versus the other. No, it's the paradox of randomness and tiny edges. There's things that are true. These are true statements. Yes, pullbacks give you higher probability. Rolling over is a time you don't want to be in. So how do we actually navigate it? Well, in this case, quite simple. If the market has pulled back, then I should be happy to take entries, but only on signals, not just buying the dip. Now, that's me personally in my approach, all right, to trading. So let's get into asking and getting answers from the data. So we like to use TradeStation. It's what we do. And we can kind of look at the market. We're going to keep this short. 2 weeks ago is 2 hours. Last week is an hour. This is going to be even shorter, mostly because of an actual time limitation that I have. So you won't have to worry about settling in for too long. All right. So here's the market, right? There's a pullback, right? We're here and now we're here. I don't care who you are. It's a dip, it's a pullback. That's fine. It's rolling over. Inherent challenge with using a phrase like it's rolling over. I think the term, I didn't do very well in English in high school, but I think the term is passive progressive. I think that's how you describe that. To say that something is rolling over is to assign it the state of continuing to do that. Like, this is what it is. It has entered to where we are as that. It is presently that. And for the foreseeable future, it will continue to be that. So it is rolling over as this continuous progressive language. The problem with that is you're assuming the future. Okay. Anytime you just label the market as doing something or being something, you're using all the information up to right now to somehow understand what the future is. And that will not lead you to profits. Okay. I've been there. It doesn't work. It will not lead you to profits. All you can do is say, what is going on now? Is there a definable statistical edge to a decision to buy, sell, or hold? That's it. That's it. Okay. So I'm going to get a different strategy in the chart. I like to just use the one that's open source for everyone in our conversations on Fridays. This is all fun stuff we did on Wednesday, so I'll just get rid of this. I got to fix the strategy because I had to leave that alone. It'll only take 1 second here. This is the one we want to use. All right, and then we'll go back to our S&P 500 friend. Go back to the daily. All right, because I want to show you the whole edge thing. Very fun fact here. I didn't even know this. This signal on the daily time frame actually has a sale this morning at the close, or at the open. Sorry, at the open. I'm not entirely sure this is a good equity curve or not. I'm just going to pull it up so we answer the question. Okay, it's not thrilling, but it's, you know, that's only 2 years. Okay, so let's give it 10 years. All right, it's not incredibly amazing. Usually momentum trading, the stock market's not. This should be, yeah, this is not a great strategy. So I'm just do one more pull of data and see if it comes out any different. Yeah, I mean, I'm going to say this sale right here. So here's a perfect example. Somebody says, oh, RSI crossed below 50 on the SPY yesterday. It's time to sell. Great. That's logical. You just impressed me with your confidence in analyzing a technical indicator and telling me what it is. Here's the language I would rather use. The RSI on the daily for SPY crossed below 50 yesterday. Historically, by following that signal to sell, you'd have a 1.3 profit factor. You'd have a 34% win rate, which isn't too thrilling, but it is profitable. You would have made 100% in almost 30 years. That's not exciting. This is a 3% edge. 100% divided by 3. Is that right? Hold on. 100% divided by, yeah, that's what I'm doing. 100% divided by, it's like 28 years. Yeah, this RSI on the SPY on the daily makes you 3.5% a year. Okay, so why get all hot and bothered about the RSI crossing below 50 and selling this now and getting back in if it crosses above when it makes you 3.5% a year? You don't. So conversation's over about that time frame in this stock, this ETF. Okay, let's move on to something else. Let's move on to something that is more interesting that everybody likes to talk about, Tesla. All right. Say, okay, well, here's a dip. Should I buy Tesla? All right. Here, somebody can say, oh, it's up too high, don't buy it. I say, I'll hold it. Why do I say I hold it? Because my signal's here and my exit's here. This has nothing to do with me. But do I have a valid reason for that? Well, let's go check the results. Yeah, that's a valid reason. There's 11 years of trading on that. Okay, that's profitable. Okay. What's our edge? 580%. in 580% divided by 11 years. That's 52% a year. Okay. So for a 52, is that different than 3.5? Should I pull the calculator up? No, I think we all know. 52.5% a year is better than 3.5% a year. Okay. Because 3.5% a year is not even worth talking about. Why in the world are we doing any kind of trading, paying any commission, slippage, risk, errors, etc.? It's not even worth checking on to make 3.5%. Okay. 50%, now it's worth talking about. Again, you don't put your whole net worth in. This is not about using one strategy, one stock, compound your count. I'm just showing you this is something actually worth talking about. High beta stock on a momentum signal. 2.3 profit factor, 50-something% a year. Not a great win rate. That's why I don't care about win rates. And good equity curve. It's kept itself under control. Let's use time-based, So yeah, from 17 to 19 wasn't great for this stock, but there's plenty of other things that were great. And there's plenty of times when it does work. There's plenty of things that work during this time frame. So as far as part of a portfolio, I like it. So now let's talk about the signal. Should I buy Tesla or not? Well, I have a absolute edge in Tesla. That's arguable because a lot of people are going to say that's hindsight. Great. I've been using hindsight for 6 years now, quite profitably. So don't throw out the truism that I'm using hindsight to trade when I'm doing it profitably. And if you're throwing it away and then not being profitable, maybe you need to rethink your attitude about hindsight. Anyways, sorry about that. Yes, I have a valid edge signal that says I should have sold there and still be out. So what's the truism? Oh, it's pulled back. It's a great time to buy. It's rolling over. It's a great time. You shouldn't buy it. What's mine? I have an actual edge. RSI cross below 50. Statistically, over the last 11 years, you make over 50% a year on average, not every year, on average, by following that signal. And you can avoid some really terrible losses at the same time. Okay. And not just that stock, many, many, many others have shown it well. Let me see if I can find a big, so here's like this whole huge drop down here. You're not in it. You have a reason to not be in it. Okay. You can avoid that. There's a book title, Skip the Dip. You can avoid the downside, ride the upside by using a valid signal. Okay. Now I actually have a complete logic statement, not a truism, a complete logic statement about how to deal with the dip in Tesla. Stay out until there's a signal. Done. Maybe I like a different time frame. Maybe I just want to not depend on one signal on one time frame or be overfit. Sure, I like that. I'm with you on that. So let's pull up 10 years on the hourly and say, okay, well, the hourly, first of all, is there an edge? I don't care what the indicator did. This is it just irritates me, and actually now I'm just saddened by it. It used to irritate me, now I'm just saddened by it. I go to trading webinars, I see trading YouTube videos, and man, they just explain the heck out of these technical indicators. And they talk about your divergence, and they talk about your confluence, and they talk about all these cool things that you didn't understand before you had the pleasure of watching this education from them. And you're just like, man, that's amazing. And then they say, see right here, and they point at the screen, say like right here, see there was this divergence here, but then it broke out and then we had a big move. And you're like, man, you're brilliant. I wish I could be like you. Okay. That's garbage. You can't do anything with it. So throw all that away. I want to know what the edge is. I don't want some fancy language in an example. I want to know the edge. Show me the edge. Okay. We used to have a segment. We even had a jingle called Show Me the Edge for a little while. So I'll show you the edge. Yes, there's an edge. Okay. 10 years, 52% a year. You could probably even go more because that was even, the other one was more than 10, I think. But anyways, about the same return. Wasn't as good right there. Somebody asked me about like, oh yeah, isn't this different, by the way? This makes money here. Wasn't the daily, it struggled there. That's why I like multiple time frame trading. 10 years. Okay, yeah. On the daily, it didn't do well there, but on the hourly, it did fine. This is why I use multiple time frames. I don't use a single time frame. I allow randomness to give me smoothness. Randomness is a good thing. All right. So now that I know there's an edge, now that I know this time frame is worth following, what do I do on the dip? I stay out. I buy there because I have a valid reason to. I bail back out. There's my low win rate, by the way. This right here just kept the win rate low. That's fine with me. It's trying to go up again. Buy again. Nope. Get out. Yep. There's 2 more losses. I'm still out. Okay. Throw away all the other stuff. Tesla fundamentals are crap. Don't buy it. Okay. That's fine with me. You don't have to buy it. It's pulled back. It's a great time to buy. It's cheaper. I'm going to add to my trade. Great. All logical. You sound brilliant. No thanks. Gets above 50 on the RSI. I'll buy it. Okay. Now that's using this one. I want to hand you, just have it. This is your trading strategy. You got it. It's simple, simple, simple strategy. Applied to fast moving stocks, diversified, can do very well for you. I use more complicated things, but basically when my if then statements that have edge and have been proven do certain things, I will participate. I don't use truisms and fancy language in trading. Okay. Anybody else see any other examples? I know we like to do this every week. As far as like that's what we're going to do. We're going to start at the Z's, right? That's what we're going to do. We're going to start at the Z's and move backwards. Last week we made it through some letters, and this week I'm going to continue to pull out of sample results for you, because I know you're not able to follow all these every day. All right, so now I only pull up 2 years, by the way, because it takes less time to load the data. All right, so it's not because the last 2 years have been great. It's because if I pulled up 10 years for every one of these, we'd be here for 2 more hours. So I'm just trying to show what has it done lately. I have seen, and I know that these things work great over years. Not every single one of them, but many of them have, and the whole concept does very well. All right, Zoom. It's too expensive. Get out, get out, get out, get out. I'll get out here. That's fine for me. I have a valid reason to stop riding this move, and it looks like it worked out fine. I love it. Love it, love it, love it. I love the fact that I trade Zoom. I'm almost certain I'm in Zoom. I'm not in it right now. That's why I'm not certain. Yeah, it's on my actual list. So I trade Zoom, and I've been out from 400 and change, because my system's slightly different than this, 400 and change down to 360. Wasn't in it, but I was in this. Okay, so that worked nicely. Oh, by the way, is there an edge? Is this valid? Should we use it? Yeah, it's pretty good. And there's a storyline to it. So is it valid just because of COVID? Well, here's COVID. Here's pre-COVID. Yes, it's valid. It's good stuff. ZG. Don't even know what to do. Wayfair, huh? That's an interesting ticker. Any requests? Let me know. I'll be happy to pull them up. What happened? W? Oh, man, I broke this. ZM. No, I just added one. Okay, let me get rid of this. Two years. So how to navigate the dip in Wayfair. Get out when this indicator rolls over. Try again, get out, stay out. That's how you navigate the dip in Wayfair. That's how you keep your equity curve moving in the right direction, because you're flat right here. Okay. Last week I told you to start in the Z's. I'm not hand picking things that make sense this week. It's the same list we looked at last week. Alibaba, huh? Baba. Jeff requested Baba, so we pulled that up. It's going to load some data. Not on the list. This is a very, very aggressive growth list. A lot of things that have moved a lot. So Baba's not in that list. So obviously it's kept you out. Okay, but how's it done prior to that? It's just not a big mover. That's still 20% in 2 years, 10% a year with some decent drawdowns. I'd say, let me just pull up some more data because it's been active for a while. I just want to see how it trades, and then I'll give you a better opinion once I get a little more data here. My view of Baba. Just do this, this, this. All right, here's 4 years. All right, that's a lot. That's 300 trades. So 300 trades makes money. 300 trades in 4 years made 85%. Okay, 20% a year. That's what we should be. That's worth our effort, right? 20% a year on your money is worth. That's like business. That's why I don't loosely and obscurely compare trading to a business. I literally mean trading is more like a business, because when you invest, you hand your money over and you wait for people to report back to you on how it did. Okay? When you have a business, you put money into it and then you work. Right? You work to make it make money and make sure you get the highest return possible. All right. That's why when it's like people think how hedge funds can never make 20% a year, you can never depend on it. Great. Yeah. If they're investing, if it's an investment hedge fund, I'm with you. That's fine. If it's a trading strategy with less than $1 billion, like, I don't know, what do you have, 5 or 10 million? Okay. Yes, you should be able to get high percent returns on that. If you work it, if you have an edge, So yes, 20%, that's worth our attention. There's an edge here. It's not fantastic. I would add it to a portfolio. Also because this is purely personal interpretation on the world. This is no fundamental or technical, but I want to at least share this with you. At some point, you have to decide things. It's good enough to run regardless, but I would lean toward the fact this is a game-changing, world-shaping stock. So I think there's the chance, like Apple just continues to go and Tesla just continues to go, Baba could resurge and its best years could be ahead of it. All right. That you can go dig in and form your own opinions on. So I would, for 2 reasons: it makes money, and secondly, I think it can make a lot more. I would run it. I don't run it, and I'm not even saying that I'm going to add it, but I'm trying to guide. You've asked about it. If I was in your shoes, I would have no problem adding it. I just don't need to add a lot of things right now. I have a lot going on. 40 something stocks, and that's plenty. Z, is that Zillow? Yes, it is. Looks like it's had a rough turnaround here. All right. Is the chart worth 10,000 words or not? How long have we been doing these meetings? 3, 4 weeks? Okay. Big, not in. You're in from here to here. Try one more time. Out. That's how I deal with pullbacks. All right. Slightly different versions that I run live, but that's how I deal with them. And I don't even know if I have that on. Yeah, I don't trade it, but we've had it on the list, and it would have worked fine if I did. I try to include the little nuances of what I'm actually doing, what I don't do. Right, Veritone. So this is a changing story idea. I don't always just say it has to have a 3-year back test. If that was the case, you'd wait too long to get into things. So it's not like the thing had to IPO and just take off from there and always do well. I'm not worried about that. If it did poorly before that and then became a high beta, high growth stock, that's fine with me. And look, here's your example of a massive run, a complete it's not even a 180. I don't even know what angle that is. Maybe some geometry people know. Whatever angle this is, a complete change in its performance. And let's say that whole thing went by and then you decided to start, it still worked. It wasn't a pretty path, but it still worked. It did it once, it can do it again. That's one of truisms for you. If it's done it before, it can do it again. No guarantees, may not, but it could. If it's here's the other way to say it that adds a little more weight to it. If it's never done it before, why are you expecting it? I think that adds a little more credence to what I say. When it's done it before, it could do it again. Or if it's never done it, what makes you think it's going to happen? I don't know, but this one did, and then it can do it again. That's fine with me. All right. It's done well. By the way, this is a buy right now. Right here, right now. With a 25% chance of success. Do you see why most people can't do this? 24, I didn't even have to look. I knew it. I knew it was 25%. I looked at the equity curve and I knew it was going to be 25%. 24% win rate opportunity right now. Who's in? I am. Not on this one, though. I'm technically not in this one, but I'm all over it. 25% win rates. I'm all over it. I'm trying to get it higher, but I haven't found a valid reason to raise the win rate. Every time I raise the win rate, the stats barely justify it. I feel like it's random. So I'm trying, though. I'm trying to increase the win rate. I just haven't quite uncovered the best way to do it without giving up too much. Twist, huh? What's twist? I have this glare, so I can never read this ghosted print. It is Twist Biosciences. Okay. Does this have edge? Oh, yes, it does. That's a 2-year equity curve. If only, if only you could just grab this one and be done with it, right? 240% in 2 years. All right. It's 120% a year. Valid? Yes. How's it done lately? Well, the stock's done crap, but the equity curve is doing exactly what you expect to do. Be under control when the stock goes from 210 to 130. Would you really think, a stock that went from 210 to 130? I mean, that's a much bigger pullback in the stock than the equity curve, right? Yes. Doing its job. TUP. I don't even have a guess. Tupperware? Are you joking me? Wow, Tupperware's on the high beta list, huh? All right, let's see. What do they got? A changing story? Yeah. I mean, that's different. Let's do, I just want to see what the long term looks like. So I'm going to do 10 years. I'm going to do a daily and 20 years. They've got to have been around that long. Okay. I struggle. I would struggle to trade this. It's quite a different shape, but I don't know. Number one, here's your reason not to buy just because it's low. There's all your reasons there. It's changed. If you go do some research and you decide Tupperware is going to like resurge and become like, I don't know, maybe they're not making anything out of plastic anymore. Maybe they make it out of plants or something and everyone's going to buy Tupperware again. That's fine. If this is just like a short squeeze, no thanks. Either way, just looking at this, I would skip it. Yeah. I mean, it's beautiful, but I would skip it. It just kind of, I got to be more selective than that. TTD, The Trade Desk Inc., Class A. All right. What are you all to? All right. You're out of this. Bunch of attempts. Catch this. Catch a little move there. You're out of this. And you're trying again here in the last 2 hours. New buy. What do you think? Pretty good. 2 years, 70% a year on that one. Tesla, we already looked at. TG Therapeutics. I say that like I know who that is. All right. Beautiful, right? Okay, over 100% a year. So that's nice. And how's it done lately? Done well. All right. So we've been doing this for a while, but I wanted to focus more on this. I like to add that in. Oh, if you have requests, I'm happy to take them. Let me look. Nice. All right. I'm going to go back to this thing as the parting statements because I want you to take personal inventory of the situation. All right. Are these things you say? Are these things that if you hear somebody else say, it makes you kind of stop and think and, oh, I wonder if they're right. You know, they sound smart, they sound confident. Okay. Or are you instead asking what the edge is? And that's you don't get quick answers from that because you got to know how to do it. Enter the sales pitch. I will show you how to do it. All right. If you want to know your edge in 10 seconds, by learning automated tools and not just this one indicator or whatever, but any kind of indicator you ever want to come up with, custom stuff, all that, I'll help you. All right. Sales pitch over. Ask what the edge is. Make it a simple edge. Don't worry about profit factors and Sharpe ratios and all that. Great. What you just said, what's the annual average return of what you just said? MACDs and divergence. I saw this one on a Facebook. I get in these Facebook groups. I don't remember when I joined, but then they show up on my feed. And I see some guys like MACD divergence on blah, blah, blah. And it's like, what is the point of this statement? Like, what is the point? Other than to just say, I know what the word divergence means and I know how to draw a line on a chart. Okay. Great. What is the average annual percent return of selling because there's a bearish divergence on this stock? There's no answer to that. So what's the point? If you have no answer and you have no edge and you have no track record, at least, at minimum, a track record from doing it at least a couple hundred times, then how will you ever scale up, even if you're right? And how many times do you have to get ripped in the face when divergence just turns into one of these other things? It was a pullback and actually a good time to buy. You say, oh, well, next time I'll just call it a pullback and it's time to buy. What, just keep jumping around like that? Learn to speak in not trite truisms. Trite, there's we got alliteration of 3. Trite trading truisms. Don't speak in trite trading truisms. Ask for the edge. You can ask the person, you can ask the data, you can build an edge. You can have an edge, you can know an edge, and you can experience it. If you have concerns about hindsight and blah, 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 those are all people who either don't know how to ask information or have asked ES and SPY the wrong questions because there's not very much opportunity there. They haven't learned how to ask the right things, the right questions, to get the right answers and execute consistently. Yes, past data is valuable. If you diversify, have enough time frames and edges, avoid common errors like underpriced stocks, low beta stocks on the wrong strategies, shorting things, whatever. There's the million different things that, like being predominantly short, predominantly negative gamma, all these different reasons why past data can hurt you and not give you anywhere close to the same result. But there's plenty of examples where the model plays out. Okay. And that's going to come through all those things I just talked about. All right. Plenty of information on formafinancial.com. Click on the automated trading part, schedule a call with me, sign up for the training. I'm telling you, this is game changing for people who do it, commit, follow it. It's absolutely game changing. I am more proud of this than any other contribution to trading I've ever made because of the sheer, direct, immediate impact that it's making on traders. An absolute 180 transformation in 4 weeks to go from trading truisms and overcomplicated strategies to a basket of simple strategies being fully automated. All right, so feel free to check that out. Also, if that's beyond your price budget and you would rather dip your toe in, we have memberships. You can click on that, and there's 120, no, it's like 130 hours now of recordings from our weekly meetings, strategies, library, some courses you can go through that you can sign up for too. So feel free to check that out. All right, love having you guys here. Next week, if you have a specific, I don't know, I can't guarantee we're going to do anything next week. I'm just kind of playing it by ear every week. If there's something specific you like to learn about, feel free, make a request and we can cover a topic. But this is where I felt compelled to share with you today about what to do with the dip. Follow a plan. That's what I think you should do on the dip. All right. Talk to y'all later. Respond to one of my emails if you want to share any feedback, ask a question about anything. All right. Enjoy your weekend. Trade with edge, not with truisms. And I'll talk to y'all later. See ya.